Markets struggle to price political risk of an election, a sick president, and stimulus that never seems to come. Welcome to Bloomberg Wall Street Week. I'm David Westin. This week, IBM CEO Arvind Krishna.
Pre this announcement, we were a majority services company. Post this announcement, IBM will become over half as a software and solutions company.
Contributor Larry Summers of Harvard. Former HP CEO Carly Fiorina.
Technology, big tech, the Valley needs to come to grips with the fact that this is a new era now.
Dan Yergin of IHS Markit. Sharmin Mossavar-Rahmani of Goldman Sachs. And Cecilia Rouse of Princeton.
We've always been warned that there could be a second wave. Let's face it, we do have to learn to live with this virus until we completely conquer it.
We started the week with President Trump in the hospital, but ended it with his saying his bout with COVID had been what he called a blessing from God.
I think this was a blessing from God that I caught it. This was a blessing in disguise.
And in between, we saw perhaps the most important vice presidential debate ever, with Vice President Pence warning about socialism.
Joe Biden and Kamala Harris consistently talk about mandates, and not just mandates with the coronavirus, but a government takeover of health care, the Green New Deal, all government control. We're about freedom and respecting the freedom of the American people.
And Senator Harris warning about continued Trump administration mishandling of the pandemic.
The American people have witnessed what is the greatest failure of any presidential administration in the history of our country.
As the polls continue to move in the Democrats' direction, markets seem to get more comfortable with a possible Biden win, especially if it's quick and it's clean. And we're more concerned with whether we'll get that fourth round of fiscal stimulus, something Fed Chair Jay Powell said we need.
We want to help the airline workers. We can do that separately, but we cannot do it unless there's a big bill.
All of which led to continued volatility pretty much across the board, but without much real direction. And to help us find some of that direction, we welcome now Sharmin Mossavar-Rahmani from Goldman Sachs, where she is Chief Investment Officer for Wealth Management. Sharmin, it's always a delight to have you here. So let me start with a hypothetical. We have a week in which we have COVID-19 increasing in infection pretty substantially in the United States. We have no stimulus bill, once again, and a fair amount of chaos in politics. And what does the market do? Well, the S&P is up 4 days out of 5, 2 weeks in a row, and the best since July. What's going on?
In fact, it's a similar question to what you had asked when I was last on Bloomberg with you in mid-July. At the end of the day, the market does trade to fundamentals, meaning people look forward and say, what are U.S. companies doing? What kind of growth can we look forward to past the acute phase of this pandemic? What do we see in terms of innovation and creativity and the resilience of American companies? And with that as the backdrop, then the general sense is that we're going to get reasonable earnings. Even without a stimulus bill, our base case is that the fourth quarter growth will be around 3 to 4%. For next year, including what we're talking about in terms of additional infections, we're expecting growth rate for 2021, let's say around 5 to 6%. And so that's going to be very supportive of earnings. We're expecting a slow but continued decline in the unemployment rate, and that'll be good for consumption. We've already seen a big turn in a lot of the economic indicators, right from the trough that we saw in April to where we are today across retail sales, home sales. We're looking at mortgage applications, looking at new orders in the ISM index. So all the indicators point towards growth, even though when we look at the high frequency data, we are seeing a bit of stall in the data. So we expect the uncertainty of the stimulus, which my colleagues in Washington have referred to as getting a bit of a whiplash, where one day we are getting a stimulus, another day we're not. And the market isn't always reacting in exactly the way we would expect to the news, but still some interim volatility. But even if we don't get a fiscal package now, we'll certainly get something in early 2021. And I think the market is beginning to look beyond that, but recognize we're probably going to have some volatility around the days of the election and possibly for another week after that.
Well, and I dare say some days this week we had the whiplash even within a given day, maybe more than once in a given day. It went back on and again, off again, on again, off again. But I respect everything you say. It makes perfect sense. Why are you on the other side of this trade from the chair of the Federal Reserve? Because we had Jay Powell come out this week and say, we need that stimulus. The error would be not having it rather than having too much.
Well, if you think of the risks, there's a lot of asymmetry to the risk that exists in the marketplace right now in terms of whether we're talking about the pace of infections. If we're talking about the unemployment level, is there more risk that things stall too much than actually things surprise substantially to the upside? So there's no doubt that any Fed chair would like to keep the balance and be supportive of growth given full employment is one of the primary mandates. So one can understand that they don't want monetary policy to be the only tool that is supporting this economy, and they don't want to risk seeing too much of a slowdown in case the infection rate is much higher and we see a little bit more sheltering in place than people are currently expecting.
Sharmin, you at Goldman Sachs recently had a virtual conference of some world-class experts on various topics, including Jason Furman, who used to be the chief economist at the White House. And one of the things he said was, okay, we're like 3/4 of the way back, but the rest of it's going to be a long, hard slog. Without special intervention like fiscal stimulus, are we going to be able to get there? Because the curve seems to be slowing down when it comes to things like, for example, jobless claims. Not as high as they were, but they're still over 800,000 this week.
Jason was actually very gracious, and he made a reference to all the work that Jan Hatzius, our chief economist, has done, and said that his expectation that we would get 50% of the way there and the remaining 50% would be a very long slog. And now he said he's been surprised that we are 75% of the way there and the remaining 25% would be a slog. So if you look at these two cases, everybody would rather have seen the 75% progress. And with the remaining 25%, it is the base case that it is going to be hard because some of the people who are, for example, furloughed may not get their jobs back, and getting retraining and finding different jobs will be a bit of an effort. So the base case is that we don't get to the 4% type unemployment numbers, 4.5%, before we actually get to 2023, for example. On the other hand, there is a lot more optimism in terms of the pandemic, in terms of not necessarily what we might see going into the fall and winter season, but evidence that maybe the mitigation strategies that we have for the pandemic are working very well for the flu. So it's possible that the flu season won't be as bad as we saw in prior years, especially given what we've witnessed in the Southern Hemisphere in Latin America, or let's say Australia. In terms of the optimism on the various treatments and therapies, one of our guest speakers at this conference that you mentioned was Dr. Luciana Borio. She was former head of biodefense at the White House and acting chief scientist at the Food and Drug Administration. And she expressed a lot of optimism in terms of these therapies that we hear about from Regeneron and from Eli Lilly. Right. And they've both applied for emergency use authorization. Similarly, on vaccines, Dr. Hatchett from CEPI, an organization that has been at the epicenter of vaccine development, production, distribution, access on a global basis, also was cautiously optimistic about having some vaccine that would actually bring this pandemic, the acute phase of the pandemic, under control in the first half of next year. So when we look at these numbers, I think there's reason the marketplace is optimistic and overcoming some of the bearish sentiment of individual investors.
So, Sharmin, just briefly here at the end, I don't want to be pessimistic at all, but is the market pricing in the possibility of increased taxes if a President Biden actually gets elected as a practical matter? Or is the market so strong it's going to blow past whether it's Trump or Biden?
There are two factors that I think investors are looking at when they're thinking about which candidate will win. One is, if you look at the long-term earning growth trajectory of U.S. equities, the long-term growth trajectory is about 6% earnings. And it happens whether we have a Democratic administration, a Republican administration, divided government, or a single party across the government. So that's one factor in the back of people's mind. The second expectation is that the fiscal stimulus under the Biden administration will be substantially greater and early on. and the taxes will be implemented later on. So that's going to be good for the economy.
Yes, there might be some upside, actually, to that tax alternative. Okay, many thanks. It's always great to have you with us. That's Sharmin Mossavar-Rahmani. She is CIO of Wealth Management at Goldman Sachs. Coming up, the House Antitrust Subcommittee says it's time to break up big tech, and former CEO of HP, Carly Fiorina, says the times they are changing, no matter what Congress does.
Technology firms need to deal with the reality that they are now in the crosshairs of Washington, D.C.
This is Wall Street Week on Bloomberg.
I don't think we like the precedent of it, and so we're fighting it. We think we're right. I think it's overreaching, and we don't think it's sort of a proper subpoena for some legal case.
That was Google co-founder Sergey Brin in 2006, defending the company's refusing to turn over records of millions of users' search queries. 14 years later, those search tools are at the heart of a House subcommittee's antitrust review. It all began in 1996 with a back rub. That was the name of the original algorithm that Google founders Larry Page and Sergey Brin developed first as PhD students at Stanford University. Page had a vision to rank links resulting from an internet search by how often they were linked by other pages. In a 1998 paper, Page and Brin made a case against ad-supported search engines, saying in general, it could be argued from the consumer point of view that the better the search engine is, the fewer advertisements will be needed for the consumer to find what they want. Google went public in 2004 with a valuation of $27 billion and a prospectus that included the company's declared code of conduct, "Don't be evil." By that time, Eric Schmidt had been brought in as CEO, but Larry Page and Sergey Brin still charted the company's course as a tech giant. In 2005 and 2006, the pair expanded Google's reach by acquiring Android and YouTube. Larry Page officially took over as CEO once again in 2011, but stepped aside just a few years ago in 2015 when the company restructured itself as Alphabet. Alphabet is now an internet search giant, serving as the parent company of many businesses touching on many parts of consumers' daily lives. In a report targeting Alphabet, Apple, Amazon, and Facebook, a House panel seeks sweeping reforms to curb the tech giant's power. Carly Fiorina, former CEO of Hewlett-Packard, says that the regulatory scrutiny is the new normal for Silicon Valley.
Technology for the longest time was secure in the knowledge that there was bipartisan support in Washington, D.C. for leaving them alone. They were in a special category. They grew the economy. No one was going to touch them. That era is over. And while there may be disagreement between Republicans and Democrats about the specifics, what there is bipartisan agreement around is the fact that big tech has too much power. There is bipartisan support for that, and Republicans said that in response to this report. There is also bipartisan, may I say, lack of trust in much of the leadership of big tech. And so whether these specific provisions go anywhere or not, I think technology firms need to deal with the reality that they are now in the crosshairs of Washington, D.C., and they need to think strategically about how to be part of the solution. Otherwise, they might not like where this ends up.
Carly, what do you make of the overall, as I take it, conclusion of this report, which is basically the very size of these very big tech companies, really the big four we're talking about now, have actually made it less likely there will be innovation, that there will be new upstart competitors to come along. From your experience, does that ring true? Because what the big tech companies say is, oh no, we're investing all the money in the world in innovation. We're responsible for the innovation.
Well, the truth is, David, I think both statements are true. I think if you look at where innovation traditionally has come from, it has come from the smaller startups. After all, that's what Google once was. That's what Amazon once was. That's what Apple once was. That's what all these companies, Facebook, once were. And it's also true that these huge technology companies now have a great interest in leveraging others' innovation, but they do so by buying them up. That's what they have done. And finally, I would say it is undoubtedly true that these companies have a market power and a power over consumers, not to mention consumer information, that's really almost unprecedented. And so I think technology companies can no longer make a credible argument that somehow they are in a different category, that if you do anything to internet-based companies in terms of regulation or oversight, that somehow you are going to curtail their growth. I just don't think that argument rings true anymore. And that's why I think strategically they need to think about how to be a part of this conversation instead of just saying, no, there's nothing to see here, there's nothing to do here. That's not going to fly.
Carly, you mentioned earlier the leadership of some of these companies. Let's talk about leadership right now. How do you lead a company that arguably is winning by too much? You had a phenomenon with IBM, you could say that happened with. You could say it happened with Microsoft. What can a leader do in that situation?
Well, first, I think I don't want to be too critical here, but I do think that some of the leaders of some of these companies have damaged their case a bit by being, we now know, less than forthcoming about what was really going on. And so we've seen, I think, too many instances where leaders have come before Capitol Hill, and let's face it, that's not a pleasant experience for any CEO, and CEOs get very outraged about the hypocrisy, all of which is deserved. Nevertheless, when a CEO is found to be less than forthcoming, that's not helpful to their cause.
That was Carly Fiorina, founder and chair of Carly Fiorina Enterprises. Coming up, the tech company that's constantly evolving. IBM is taking another step forward, becoming a major cloud services provider. CEO Arvind Krishna says this is just the beginning.
We are focused on growing both those companies, so they will take the appropriate actions, whether it's organic and inorganic investments, meaning acquisitions.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. In its 109-year history, IBM has reinvented itself to stay at the top of its game. This week, the company did it again with its announcement that it would be spinning off its infrastructure services unit to focus more on cloud computing and artificial intelligence. Arvind Krishna, who took over as CEO in April, has said he will pursue growth relentlessly, and his services business has been struggling during the pandemic. I asked him how this shift fits in with his vision for IBM's future.
Pre this announcement, we were a majority services company. Post this announcement, IBM will become over half as a software and solutions company, and even a larger number in terms of overall product. And if I look at the annuity base of the new company, it's about a little over 50%. So if I look at that, that's a very attractive company that promises a different valuation than the current structure. So that is a piece of it, but I think it's actually more the growth and the addressable market opportunity of $1 trillion that I think is driving it.
So Arvind, what will be the relationship between these two companies? Will they be contracting with one another? Will they be free to contract with other people that might be even a competitor of their sister company?
Both. So absolutely, you unlock growth for both companies by being allowed to partner with those that may be competitors. Certainly for NewCo, they may today not so much be restricted, but others who are competitors of the aggregate may feel reluctant to partner deeply with them. That gets unlocked. No constraints, no restrictions on that side. Now that said, I think it's likely that we're each other's biggest customers on day one post-spin. They certainly purchase a lot of hardware and software from IBM. IBM certainly purchases services from NewCo in terms of how we run IT infrastructure and so on. So the two companies are going to have a deep strategic relationship, but that is not going to constrain them both from partnering with whoever they want to.
Arvind, you clearly want to gain some growth by freeing up the hybrid services and the AI part of the company. Do you also run the risk of losing some of essentially cross-selling, have customers you can cross-sell both sides of your business?
I think that that's a risk that can be managed, David. So the word I would use is, I don't have any concerns about it, and then I'll sort of say, of course I'm going to be paranoid about it, and I'm going to have lots of work around it. And so I'm going to mitigate any of that risk in terms of how we work. There are certainly common clients across both sides of the business, but the clients tend to contract separately for the different parts of the business already. So we have to go manage that risk. But as I said also, the two businesses will have deep and strategic relationships with each other, and that will also help mitigate that part of the risk. So I think we'll unlock growth, and I think that the risk on the aspect you mentioned can be mitigated.
Arvind, you and I will say, both understand that when you have this major structural change, it consumes a lot of executive bandwidth. As a practical matter, that probably means you're not going to be looking at other acquisitions or dispositions over that 12-month period. Can you look out beyond that? Do you see further structural changes coming up for IBM to pursue that relentless desire for growth that you describe?
I absolutely expect to be completely focused on acquisitions as well as on organic R&D and organic ecosystem investments. I don't believe we will pause them in this period. You then talked about other structural actions, meaning divestments. We are not planning anything else that is significant. So this will take time. You're right. It is major, and it will take a whole set of people to go get this done. And but in the meantime, we are focused on growing both those companies. So they will take the appropriate actions, whether it's organic and inorganic investments, meaning acquisitions, to go get themselves positioned. We fully expect to be down all those paths at full speed.
That was Arvind Krishna, CEO of IBM.
I'm Sophie Kamarudin. Time for a Global Markets Week in Review. Asian stocks regained some momentum to reach June 2018 highs, and Chinese markets reopened on Friday. It was a positive start to the month after an 8-day break for mainland markets that saw better than expected domestic tourism in China. And we got more signs of cyclical upside this week. Samsung delivered a profit beat helped in part by Huawei's chip stockpiling, plus the world's largest chip maker, TSMC, posted a sales jump before Apple launches new iPhones next week. Danny?
Sophie, the big story this week are leaders across Europe trying to put in more restrictions in place as coronavirus cases rise throughout the continent and the UK. We're seeing some regions hit new records in daily case count, but this time around, there's more resistance. For example, in the UK, Boris Johnson's own party and local leaders are giving him some pushback around new restrictions. Spain, the court's ruling that some of the restrictions to Madrid they couldn't go through with, but still, we are seeing more restrictions from cities to Paris like Berlin, closing nightlife early, so certainly more efforts being put in place. Scarlett?
Here in the U.S., fiscal stimulus remains the short-term focus. Markets are increasingly pricing in a Democratic sweep, especially for sectors including renewable energy and cannabis. Looking ahead to next week, the focus turns to earnings. The 6 biggest banks start reporting on Tuesday. And the last go-round, they're very aggressive with setting aside money to cover potential bad loans, a combined $35 billion. This time around, they're expected to set aside less money. Now, I'll be listening for any color that the banks offer on whether they're making it harder to get loans at a time when there's no clarity on future government aid. Also, trading revenue in equities and fixed income are likely to remain a bright spot, especially for Goldman Sachs and Morgan Stanley.
Coming up, a second wave of the coronavirus is threatening the global economic recovery. Cecilia Rouse of Princeton says that we have to learn to live with the virus.
We will be taking some risk, and I think that we do need to do that. It's very hard to stay sheltered in place for a year and a half.
This is Wall Street Week on Bloomberg. Countries around the world are facing a second wave of COVID-19 cases. In Europe, Brussels joined the ranks of Berlin, Paris, and Madrid in imposing restrictions on nightlife.
I don't know about you, but I have had more than enough of this disease that attacks not only human beings, but so many of the greatest things about our country.
There are some key differences in how leaders handled the first wave of the pandemic. In a recent study, 2 economists found that on average, the countries run by women suffered half as many deaths from COVID-19 as the nations governed by men. They matched the 19 countries led by women with their nearest neighbors.
Female leaders are much more empathetic. They have a leadership style that is much more democratic, much more communicative.
In New Zealand, Prime Minister Jacinda Ardern imposed not one but two strict lockdowns to tamp down the virus. As of this week, the country has had just over 1,500 confirmed cases and 25 deaths. When the virus first hit, Ardern introduced some of the strictest restrictions, including a ban on food delivery services.
We know that limiting people-to-people contact really helps stop the spread. We have a plan, we have acted quickly, and now we'll continue to roll out that plan.
Ardern wasn't the only female leader to spring into action. Erna Solberg, the Prime Minister of Norway, imposed a nationwide lockdown in mid-March and gradually began easing restrictions in May. The country has reported 275 deaths as of this week.
You see countries across Europe trying to grapple with what can they do in terms of tightening restrictions that may just get this under control without them having to go back into a full-on lockdown, which would of course be devastating for the economy.
German Chancellor Angela Merkel has been praised for her scientific approach to dealing with the pandemic.
I want to do everything I can to prevent a new nationwide lockdown. I'm saying that because I absolutely want to protect businesses and jobs.
There is precedent for female-led cleanup efforts. In 2008, Iceland's female prime minister and an investment fund founded by two women helped get the country's economy back on track. The global economic recovery from COVID-19 is facing a new challenge as governments debate how to handle a second wave of the virus, scientifically and economically. Cecilia, Rouse, dean of the Princeton School of Public and International Affairs, dealt with the aftermath of the Great Recession in 2009 as a member of President Obama's Council of Economic Advisors. We asked her whether another lockdown is the best way to deal with this crisis.
We've always been warned that there could be a second wave. And so some of that is likely because we are relaxing our own, physical distancing. Let's face it, we do have to learn to live with this virus until we completely conquer it with a really effective set of vaccines, really effective therapeutics. So until we get to the other side, we will be taking some risk. And I think that we do need to do that. It's very hard to stay sheltered in place for a year and a half. So they are likely because of that, but I'm not an infectious disease expert. They did warn us that a second wave could occur.
You're not an infectious disease expert. You are an economist, though. And as you look at the economies around the world, can you see any correlation between economies doing better because they did a better job, we think, on the public health?
So we do see that the unemployment rates in particular are not as high as in the United States. Some of this is the way in which countries try to compensate people to help get through this this economic crisis caused by the health crisis. So I do believe that economies that have kept it better under control have been able to do things such as get more children back to school. And so when children are able to go to school with appropriate safety measures, then their parents can work. One of the other phenomena we've seen is that women have withdrawn from the labor force at very high numbers because somebody needs to be home to take care of the children who are not able to go to school in person. So I do believe if we look around the world that countries that have the virus better under control haven't been suffering as much as we have. But the reality is until we're really behind this, everybody's going to be suffering to some extent.
I'm glad you raised the issue about women, particularly not participating in the workforce. And we're told in large part because, as you say, they have to take care of their children. There's still some difference there, I guess, in gender between the two. To what extent has this really, the employment situation particularly, hit some of those who have been behind anyway harder than the rest, whether it is African Americans, whether it's Hispanics, whether it's women?
So we do see that this virus has exacerbated the inequality that already existed in our economy. So in February, when this first hit, our unemployment rate was 3.5%. And so it was overall doing pretty well, but there was inequality. There were some cracks in the system. Not everybody was doing as well as others.
Dean Rouse, we heard from the Fed chair, Jay Powell, this week, where he said in no uncertain terms, to get a full recovery, we need more fiscal stimulus. Do you have any doubts in your mind, as an economist who've really looked at this economy, is there any doubt in your mind we need more fiscal stimulus?
I completely agree with Chairman Powell. I actually am quite stunned that Congress has not passed another bill. I like to think of it as relief because in some ways we don't want to fully stimulate the economy. We want people to be able to physical distance and stay home if they need to stay home, or if there's not a job available, we need them to be able to pay their bills. But in paying their bills, that is keeping our economy afloat. Because if somebody is not able to pay their rent or is not able to buy food, that's actually money that's not going back into the economy. So what we understand is that these kinds of fiscal stimulus measures, when there's not other economic activity, actually help to keep the economy afloat. Many people worry, but our federal debt and deficit is so high. That is true, but remember there's a denominator. So we want to think of how much federal debt there is compared to the size of the economy. As people are unable to spend money on rent and food and other essentials, or even things that they just want to spend money on, then that denominator, our economic activity, gets smaller, and we're not able to carry the debt that we do have. So the fastest way to recover is for the federal government to step in. Interest rates are extremely low. We have critical needs that we'll need to take care of. But importantly, we want to reduce the suffering, help people be able to stay in their homes, buy food, take care of their families, which will have a multiplier effect and keep the economy afloat more generally.
That was Cecilia Rouse, Dean of the Princeton School of Public and International Affairs. Coming up, energy policy is one of the major issues that separates President Trump and former Vice President Biden. Dan Yergin, vice chairman of IHS Markit, says the future of energy might be out of either of their hands.
There are 280 million cars in the United States, and about 279 million of them run on gasoline, and I don't think people are going to throw away their cars. So I think this is a longer evolution.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. President Trump and former Vice President Biden have very different ideas about energy policy in the United States. President Trump wants to solidify America's position as the top oil and gas producer, and Democratic nominee Biden is setting his sights on reducing the country's reliance on fossil fuels with a $2 trillion climate plan. Dan Yergin, vice chairman of IHS Markit and author of the new book, The New Map: Energy, Climate, and the Clash of Nations, says that there is an inevitable energy shift underway.
It is a pretty big gulf between the two candidates. The Trump administration has been focused on this new position the United States has as the world's #1 producer of oil and gas, and what that does for the economy and what it does for the position in the world. Joe Biden has a $2 trillion climate action plan, which is very focused on addressing climate things. And I think in terms of oil and gas, it's a little unclear where he is. He made a point to say when he was in Pennsylvania, where there are a lot of jobs related to fracking, as it's called, that I'm not going to ban fracking. But clearly, it's a pivot towards climate, and I think certainly more regulation around oil and gas.
From what you know of the technology and the development and the markets, because the market drives it as well with the prices, is this sooner or later that we're going to have a fundamental shift away from fossil fuels?
I think it's an evolution that's going on. I think you mentioned electric power, and I was recently with a bunch of the leaders of the electric power industry. They do look to be net zero carbon by 2035 or 2040. Many of them are moving that direction. Other parts of it, I think it evolves over time. There are 280 million cars in the United States, and about 279 million of them run on gasoline, and I don't think people are going to throw away their cars. So I think this is a longer evolution. And I think there's what happens in the U.S., but the U.S., remember, is only 15% of CO2 emissions. China's twice that. India, other emerging markets are looking towards commercial energy to get away from burning wood and waste in people's houses with the health consequences. So I think this is something that unfolds time. Directionally where it's going, that's clear.
Directionally, the timing really matters, and the bets can be rather substantial. In your book, you point out how many jobs in the United States, I think there's 10 million, are tied to the energy industry. We also have trillions of dollars globally. Who's putting bets on which side of this? And we saw a report today that Exxon, basically internal documents leaked, suggest that Exxon is not moving as quickly as maybe some others away from fossil fuel emissions. China certainly might benefit, you point out in your book. Russia, maybe not. Who's betting on which side of this?
Well, let me say, I think the Exxon thing, of course, that's a still unfolding story. But I think what's happening is all major companies now are looking at their emissions and saying, what are they going to be? And then the question becomes, how do you mitigate them? And in the new map, there's this whole chapter called Breakthrough Technologies, based upon the work that Ernie Moniz, the former energy secretary, and I led for Bill Gates Foundation and Breakthrough Energy Coalition, about the technologies we need. And one of them that's really very major is what's called carbon capture, carbon mitigation, simply when you look at the numbers. And I think that's where, we're going to see increased investment going in terms of research on that to meet it. In terms of countries, China's a significant winner here because unlike the US, it imports 75% of its oil, and it regards that as a major strategic problem, particularly in the geopolitical issues that are now developing. And it has a dominant position in many of what they call the new energies. For instance, about 70% of the solar panels in the world are made in China, another 10% by Chinese companies. And it's Chinese manufacturing that's partly responsible for this revolution in solar costs, which have come way down. So, they would be a big beneficiary of this.
That was Dan Yergin, Vice Chairman of IHS Markit. Coming up, we wrap up the week with special Wall Street Week contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Westin. As we do every week, we welcome now our special contributor, Larry Summers, former Treasury Secretary, to help us make sense out of this week. And I have to say, let me start, Larry, with the drama, maybe soap opera of the stimulus bill. On again, off again, sometimes in the same day. We had President Trump saying, I'm walking away from the table. I don't want to talk about it. We had Nancy Pelosi tell us here at Bloomberg, I'm not doing it unless it's a big deal. And then at the very end of the week, President Trump came back and said, no, I want to do more stimulus than anybody. I want to do more than Nancy Pelosi. But in the end, do we need it?
David, we do need it. It's very clear that it's the right thing to do. Look, doing without stimulus at a moment like this is kind of like wading into a crowd not wearing a mask in the era of COVID. It might turn out just to have been a mistake for which you didn't pay a price, but very likely it will be a mistake for which you will pay a very big price. There are all kinds of signs that the fast bounce back that the economy was enjoying isn't going to continue of its own devices. COVID's getting further out of control as we move to winter. Financial strains are increasing and interfering with the flow of credit. Layoffs, which people hope to avoid, they're bowing to necessity and laying people off. The situation globally is complex at best. Stimulus is recovery insurance, and nothing is more important than maximizing the prospect that the recovery continues.
So, Larry, given that, the markets were up. The S&P was up the most since July this past week, and it's had 2 weeks up in a row. Are the markets basically saying we're going to get the stimulus sooner or later no matter what because we think maybe Joe Biden's going to end up being president?
If you look at the internals of the market, there are signs in that direction. The companies, for example, those involved in green technology, they're thought most likely to benefit from the kind of recovery program he would propose, are up disproportionately relative to other companies, such as those in very brown industries, where there's a sense that the company depends more on the Trump administration. So I think the expectation of Biden's stimulus is an important part of it. The expectation that if the economy starts to melt down, the Fed will have to go into more rescue. And the Fed's rescue tricks are basically about credit, and that benefits stocks much more than it benefits workers. And so some of it's a bet that we're going to have to rely on that. But anyone who said the stock market's up, therefore everything's okay, is a fool. And you saw that this week when there were moments when it looked like we weren't going to get stimulus now and we weren't going to get stimulus soon. those were the moments when the market was weakest.
Yeah, and Larry, I have to give you credit here. On this program earlier, some time ago, you said the chances were larger, there'd be a blue wave, that is to say the Senate would go Democrat as well as the president. Those were a larger set of odds than actually the possibility of Donald Trump getting reelected. But let's go to the other big risk out there, which is COVID-19, which we see rising once again in the United States. You say we need stimulus for the economy. What do we need to battle COVID-19?
We need to do the things that the rest of the world has figured out to do. You know, it's amazing. I had occasion to see the statistics on Pakistan. Pakistan's not a country that's known for its competence and aptitude in getting things done effectively, but they are doing much better than we are in terms of containing COVID. Some of this is a broad cultural thing that in America we focus more on private health, and we'd be well advised to focus much more on public health in all of its various dimensions, like preventive medicine, like investing in socioeconomically depressed populations. That's a part of it. But the other part of it is raw, unadulterated incompetence in rolling out tests, in encouraging people to do dangerous things, in leaders role modeling cataclysmically bad habits. I mean, let's be clear. In the same way that everyone knows that you tell your kid not to drive when they're inebriated, you don't go looking for COVID by wading into crowds at potential super spreading events with no masks. And we are reaping what the President of the United States has sown here, and it is inexcusable. And there's more people that, you know, there are more people than died in the Vietnam War and every war since who would not have died if we had managed to function at an average level of competence, not a high level of competence, an average level of incompetence for industrialized countries.
So, Larry, we always want to conclude with a lightning round here of a few things. Let's figure out who got too much this week.
We're pointing towards the airlines getting too much. We do need to keep the planes flying, but there's no reason why we need to keep the stock prices of the airlines up, and there's no reason why people who bet on airline bonds and airline credit earning a 7% spread because it might be risky, they should take the consequences and not get paid back in full as part of any bailout. And there's a bipartisan error being made on that.
Okay, so if the airlines are getting too much, who's in risk of getting too little right now? Who's getting shortchanged in the economy?
Women. Everything about the COVID recession is particularly burdensome for women. You've seen the female unemployment rate go above the male unemployment rate for the first time in a very long time. You see it in what people with careers are experiencing, because it's women who are disproportionately bearing the burden of kids who are still at home. And that's a very costly thing for our country's future. The successful assimilation of women into the labor force over the last decades has been an important thing that has driven our economy forwards. And if that stops, that's going to matter long after we've somehow put COVID behind us.
Larry, we're seeing a lot of contests, certainly in the United States of America and around the world. We have a presidential contest going on. We saw that vice presidential debate earlier this week. So in all these contests, who's winning at this point?
Authoritarians, perhaps Xi Jinping. Look, American democracy in the UK, democracy in Brazil, democracy just isn't looking like it can keep people secure. The central challenge going forward is making sure that government by the people also actually is government for the people. And when you see things like our incompetence in dealing with COVID, when you see the magnitude of the way leaders in the United States, and not only in the United States, are pitting one group in the population against another group in the population, when you see the magnitude of the differentials that are arising between rich and poor, 10 years of life expectancy, the equivalent of 3 times the total burden of cancer, when you see all of that, it's got to be something that makes our adversaries who believe in authoritarian systems feel like their example is managing to win out over ours. And going back to John Quincy Adams, to George Kennan's strategy for winning the Cold War, to the most thoughtful diagnoses of why the Berlin Wall came down, it has come down much less to the power of our arms than the power of our example. And our example is in more tawdry disarray than certainly any time in my lifetime.
Well, that's pretty sobering, but very valuable at the same time. Larry Summers, you can see why we turned to Larry at the end of the week, because he really does wrap it all up, goes around the world and explains it all to us and makes some sense of it. We hope, in fact, that things get a little bit better and in fact that authoritarians don't end up winning the way Larry Summers, former Treasury Secretary, predicts. So that's going to do it for Wall Street Week for right now, an eventful week in which an awful lot happened, some of it good, some of it not so good, but all of it affecting the markets. Finally, one more thought. Self-medicating in the time of the pandemic. A Rand Corporation study out last week confirms what many of us have suspected. Many of us are coping with all the stress and anxiety by turning to alcohol, with what is described as a striking increase in how often and how much people are drinking. And to add irony to an already difficult situation, increasingly the authorities are trying to fight the pandemic that drove us to drink by, you guessed it, shutting down the bars.
So while the measures I announced today will feel like a backward step, and in many respects I know they are in the interest of protecting our progress overall.
But now, into this delicate situation comes Silicon Valley with a possible solution. A startup called Bespoken Spirits is using technology to help you create your own version of whiskey, rum, or brandy on demand in the quiet of your own home, letting you skip all that aging in a barrel for years stuff and come up with something that in blind taste tests seems to pass for the real thing. Call it a sort of Nespresso machine for your cocktail. So, if at the end of a long week on virtual Wall Street you need a release, we may soon have a virtual drink you can have as you stream your favorite movie and watch it in your virtual theater, otherwise called your living room. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.